Welcome to the BF Anderson Technical Report for February 22nd. We've just had the first correction in the market in quite a while. It's been over a year. And you can see here, we really ran up quite a bit in the month of January. You can see it just, the market was kind of just breaking out, moving up a steady pace, and then really got steam going in the first part of the year. Now, we had the tax bill, we had so many things happening that were just causing a lot of euphoria. Well, then we have the correction, which was about 11%. Now, I'm using the Value Line Geometric Index as the index. Remember now, this is a 1,700 stock index. Been around since the early 70s. Good index to keep an eye on simply because it's equally weighted. It really gives you a feel for the performance of the average stock. Now, what I'm showing here is something called a U bottom, a V bottom, and then a W bottom. Now, V bottoms are very rare, and they usually occur in very strong markets. So this could turn into a W bottom where we've rallied up. Now we retest the lows again. Usually the right side of the W is lower than the left side of the W, and then there's your bottom. Then you start rallying again. So the bull market is still intact. It does appear at this point we have a V bottom, but we'll just have to see. Now, back to the Value Line Geometric Index on a long-term basis. And what I want to talk about here briefly is stock market bubbles. And we've had about 19 years of sideways action. This is not what a stock market bubble looks like, because I'm going to show you a graph here next that pretty much shows that type of situation. So actually, bubbles do not form in sideways markets. So if you think about what a bubble is, it's where there's a lot of euphoria. People get interested in a certain sector of the market. It goes up and it goes up and it goes up over a period of years. And then it finally just exhausts itself and you have a bear market and usually a recession. So we had a successful retest of the breakout that took place in 2016, 2017. So you can see here, we had a little mini bear market going into the election. Then we've rallied. We've broken above a 19-year trading range, and we're now up. We can see the tremendous rally we had in the early part of the year, and now we've corrected back down to the breakout level. So things still look good. We're still in a bull market. Now, this is what a bubble looks like. This is Cisco Systems. Now, back in the early 90s, going back to 95, this stock really started to rally. And you can see the tremendous up move that was going on. It went on for a period of years, about 5 years, and then it formed a bubble. And then you can see here that after the bubble popped, the stock got up to around $66 a share, split adjusted, and the bubble caused the stock, once it popped, it dropped all the way down to $5. So we're looking at Cisco losing 80% of its value from the high in 2000 to 2003. Now, it then has been consolidating for an extended period of time. We're talking, about, approximately 17 years of consolidation and repair. Now, Cisco's starting to break out, and so I think there's implications here for technology, because if something like Cisco is starting to come back, I think it has a good sign for the overall tech group. But you can see here, buy and hold really didn't work in this situation. You lost 80%, 90% of your money, then it took you 18 years, and we still haven't gotten back. So this is a kind of an extreme example. There's a lot of companies that did come back, but then there are some companies back in 2000 that the bubble popped on that didn't come back at all. Now, here's a ratio. I want to talk to you about ratios for a minute. This is the Standard & Poor's compared to the 30-year Treasury bond. This is a ratio of the two. So when the line is going up, when the ratio is climbing, stocks are doing better than bonds. When the ratio is declining, bonds are doing better than stocks. Now, things are changing. We are seeing a major change here because we are now seeing a breakout of stocks above bonds, meaning the ratio has improved dramatically. And this has been going on actually since around 1994. So we're looking at a real extreme period of time. Now, from a probabilistic perspective, just a probability, we want to look at a pattern that is formed here. It's called an inverse head and shoulders pattern. Here's your left shoulder, here's your head, here's your right shoulder. If the right shoulder is higher than the left shoulder, and then you follow through with a breakout, that pattern has a probability of being meaningful. So we are seeing a dramatic change here in the relationship of stocks to bonds, and there is a definite correlation there. Now, another ratio that I think is interesting is where I'm comparing the emerging markets to the value line geometric index. So I'm comparing international stocks in emerging markets to U.S. stocks, the average U.S. stock. Now, something interesting has happened here. The ratio, again, if the ratio is going up, the emerging markets are doing better than U.S. stocks and vice versa. Well, we've gotten here in January. We got a breakout of that relationship and that ratio in January. Now, we pulled back in the correction just like everybody else, but it's actually starting to rally again above the box that has formed over an extended period of time. Now, here's another ratio, a similar concept, but this is where we're looking at the Chinese index, which is the PGJ. Now, the PGJ is called the China Golden Dragon Portfolio, and it's all stocks that trade in the United States that are called American Depository Receipts, that trade in the United States, that are based in Beijing or in China or so forth. You can also see that this relationship, this ratio, the Chinese stocks are outperforming the U.S. stocks starting really in the beginning of 18. We broke out in the beginning of 18 and actually made a new high here recently. Now, the top five. Now, I want to mention about the watch list. This is not a buy list. This is nothing more than a way for us to look at pure momentum of stocks that are going up the most in our database, but we have not done the amount of fundamental work that we would do on something that we actually add to the portfolio. So this is nothing more than a way to kind of get a handle on which stocks are really out there performing the best. Well, here's AbbVie, been on the list for a while. Biotechnology, strong uptrend. Here is Global Blood Therapeutics. Again, biotechnology. We're seeing a lot of biotechnology stocks that we should continue to pay attention to. This company is doing some interesting work in blood testing for cancers. Now, here's an interesting name that just made the list, W.W. Grainger. This is an industrial supplier. So we're starting to see the industrial stocks start to get some momentum. Again, back to Netflix. This is a stock that we own in the portfolio. Really like Netflix. It's acting well. It meets all of our fundamental work. When you compare Netflix to something like an Amazon, it's very different because Netflix is making money, their profit margin is very high, and their most recent quarterly earnings were quite good. Finally, the last stock on the list that continues to make the list is Twitter, which is another internet-based company. Now, we know of another company in China that's like Twitter called Weibo that we would look at as a Chinese alternative. So that's it. Anybody have any questions, please let me know. Thank you.